Hi, Don.
Hi, how are you, Ann?
Well, how are you?
Very good, very good.
Good. We're just going to give it a couple seconds here, and then I'm going to welcome everybody. So um, we are going to go ahead and get started. I want to thank you, Don, and I want to thank anybody who's tuning in or watching later for joining us for another episode of Ask the Experts Online. So this week, our expert is Don Frutchey of First County Mortgage, and we're going to talk about how the coronavirus has impacted home financing. So thank you for joining us here today, Don. We'll get into a little more of an intro in a bit here. I wanted to thank our viewers for viewing and coming to our 7th episode of Ask the Experts Online. We skipped last week for Memorial Day weekend, and I hope everybody enjoyed the shortened week and had some fun with family and friends, or resting or honoring the folks who have served. We have been getting together on a regular basis and interviewing local businesses and having great conversations with them to bring good information to our viewers. And much of it is related to or has been impacted by COVID, whether it's being in your home and needing to organize, or, hey, I'm thinking about a refi or a purchase. And Don's here with us today for that. So as many of you know, I operate a small business and I work by referral. And I feel very strongly about referring other quality local businesses. And so that was sort of the advent of this, Ask the Experts Online, because in the past, we've done a forum a couple times a year where we get experts together and people who need experts. And so this is a way we can bring you one on a regular basis. So what we're going to do is we're recording this. It's going to be available later on our Facebook pages and on YouTube. And you can also reach out to us for a link, and we'll happily send that along. And we would love it if you would share the information or the link with folks you know who might benefit from the information. Our goal is to share really good content-rich information with you on the topic of expertise of the day, which Don is going to talk about. And then if we have time, we're going to get to some of your questions. So thank you again for joining us this week. As I mentioned, I want to thank our guest, Don Frutchey. Don, I feel like, go like this. Can you high five? Other way. No, wow, other way. Anyway. I was going to say, welcome our guest. Okay. So this week, I'd like to thank Don Frutchey of First County Mortgage. Don has been in the business since 2002 and has closed almost $750 million in loans. That's a lot of houses sold and refinanced, Don. So Don enjoys a social survey score of 4.94 out of 5 from 77 reviews just in the past year with First County Mortgage. So really, really good scores, Don. We're proud of you. Thank you. And Don loves working with buyers to solve problems and come up with the best solutions for their needs. He's helped many of my clients over the years, dozens and dozens at this point, and I really enjoy working with you, Don. So thanks for joining us here today.
I appreciate that, Ann, and I really do appreciate you pronouncing my last name correctly.
Yes, happy to, Don Frutchey. I have pronounced many ways over the years. So each week, we're going to give a little quick DC market update because I get a lot of questions about that too. And I'm sure that about the market, and I'm sure that Don does also, even though he's approaching it from the lending side. So I wanted to tell you, every week we've been improving how the market has performed in light of the pandemic. So if you were to look at the metro region over the last 2 weeks, at the 2-week period that ended this past weekend, and compare it to the same 2 weeks the year before, you would find that throughout the region, we're only down 7% on contract activity, which is incredible. And that is really the best week we've seen since the shutdown started. So I don't think that's too far off. And clearly we've improved every week. So I think we're definitely tracking the right direction. The other interesting thing is inventory is so tight right now. The number of days on the market is 29 days average. That a home spends on the market in our metro region, which again is Montgomery and Prince George's County, District of Columbia, Fairfax and Arlington counties, Prince George's, Prince William, Loudoun. And so when we look at these numbers, the average home is spending 29 days on the market before getting a contract. And last year it was 28 days. So obviously inventory is tight. And then I wanted to tell you that in my own experience, I've been putting listings on in diverse price ranges in the 400s up to 1.3 million. And then in areas between Rockville, Silver Spring, Arlington, Centerville, Reston. So we've been working throughout a lot of the region. And what I'm seeing is very tight inventory, very short supply, very interested buyers, very motivated sellers. So things are definitely going the right direction. So without belaboring it too much more, if you've got any questions about specific areas, your neighborhood, or something you're interested in, certainly reach out to me. We're happy to help. But let's get on to the lending side with our friend Don Frutchey. These, Don, have certainly been interesting times. I wanted to have a conversation because it's kind of unprecedented. We've got a pandemic, which has been very disruptive to business and lending processes. But on the other hand, we have these several weeks sustained now historic low interest rates. So it's like the old saying, you know, the best of times and the worst of times. Sorry about that. Somebody had a comment, I guess, on my phone. But anyway, so what I wanted to ask you is, we're getting a lot of questions, there's a lot of apprehension in the marketplace. And I've had a couple of my own contracts fall through. What are you seeing as far as issues related to the pandemic? Like what's on your radar screen?
Sure. Well, Ann, first I want to concur with the analysis you had of the regional market. It has been a crazy market with close times shortened and competition increased. And the pandemic and the COVID-19 related issues just compound the complexity of what we do in such a short time frame. So the two main issues that I see are impacting us right now are the credit and the qualification overlays that the lenders have put onto loan products, as well as the appraisal delays and the accommodations that we've had to make for appraisals. You know, in terms of the qualification overlays, yeah.
Yeah, will you define what overlay is?
Absolutely, yeah. So every entity has their own underwriting guidelines. Fannie Mae, Freddie Mac, FHA, VHDA, and we typically use those guidelines as they're written. However, any bank or mortgage bank, such as we are, will make certain adjustments based on their perceived risk of the marketplace and their concern about being able to sell their loans on the broader market after they close. So they create additional overlays. Banks will do this, mortgage banks will do this, and the main overlays that we're seeing these days are increases in the required FICO scores. So for instance, if an FHA, we have an FHA requirement of a 640 FICO score, that may have been raised up to a 680 FICO score. So it certainly limits the available pool of buyers that can qualify for an FHA loan. In addition, we're seeing debt to income ratio restrictions. So previously, if say we've been able to go to a 50% debt to income ratio, that's the ratio between your gross income and your overall monthly liabilities. We've been able to go to 45%. Now we're limited in many cases to 50%. We're limited to 45% for the debt to income ratio. So that again reduces the pool of available buyers for a particular home and the ability of a buyer to purchase the home that they had hoped to do. Now there are various workarounds to some of these items, but by and large, those have restricted what we can do for a great portion of people. So those are the credit overlays. Those are the overlays that we put on top of the standard underwriting guidelines. Does that make sense?
Okay.
All right.
Yeah, it's helpful. You think of it like, here are the underwriting guidelines. Fannie, Freddie, whomever, and particular banks are maybe putting their own little overlay,
right,
you know, right on top of these. This is your full set of requirements.
Yep.
That's how we can do it, right?
Exactly. Yeah.
No, that was really.
Yeah, and then the two biggest of those, as I mentioned, the DTI and the credit overlays, those are where we're seeing the biggest impact on what we do right now for borrowers.
Okay, and debt to income, for those of you watching who may not know, is what he referred to as DTI, debt to income.
Correct.
Okay, well that's really helpful to know, Don, because we hear these words overlays, but a lot of the general public doesn't know what that means.
Right.
And I learned early because we had a contract fall through because of a COVID overlay, and another one fall through because of a job loss.
Right.
So I'm sort of sensitive to it, but I still talk to realtors who haven't seen any of that, and they're not familiar with it.
And one thing to keep in mind, I'll interject that as a borrower is working with a loan officer, you may go through the process, and we went through this several different changes over the last couple of months as these overlays became a normal part of our operations. We make adjustments on the fly as to what we can and cannot do for a particular borrower. So hopefully, once a borrower is ready to write a contract, ready to get a pre-qualification or a pre-approval letter, we know where the overlays stand at that point. So once the contract is ratified and the loan is locked, those qualifications can't change, or the overlays can't change. Although they might change for an individual bank once we've locked on a particular date, they typically cannot change the overlays backwards once we've locked or registered a loan. Does that make sense?
Yes, it does make sense. And I guess these things are changing all the time, right? I mean, are you seeing?
Absolutely. Yeah. In fact, we've seen many banks have changed the overlays for the better. So we've actually been able to come back and reduce the overall overlays that we've got. For instance, the example I use for the FHA loan, the government-backed loan, we can actually go up to a 660 credit score now as opposed to a 640 just 2 weeks ago. So yeah, we are seeing changes, and based on where the pandemic leads us and the issues on the back side of things, the perceived risk of many loans, that's where these overlays come from, is the perceived risk. Those will continue to be adjusted for the better or worse, just depends on where we go from here.
Okay, so I guess one of the things that we're hearing a lot about, and this sort of feeds into that, are pre-closing conditions, right? So, you know, I mentioned a situation I had where somebody had job loss. Obviously, you're not going to qualify at all if you lose your job. I mean, it'd be really rare.
Right.
But then, you know, verifying employment and that kind of thing. So these pre-closing conditions, it sounds like some of them are loosening up, but from where we were this time last year, they've really tightened down, right?
Oh, absolutely. Yeah. I'll use employment. You mentioned that as one of the primary last minute conditions that we've seen an adjustment to. Typically, we've always had to verify income prior to settlement and employment prior to settlement. Typically, we've verified or re-verified that within 10 days of settlement. We just need to make sure they're still employed prior to settlement. That was the general rule, was 10 days prior to. Now that has changed to 3 days prior to. So in other words, 3 days prior to settlement, business days, we have to verify that the borrower is still employed and still makes the income that we've calculated for the approval on the loan. That can be problematic because many companies use automated systems that we're required to go to. They won't answer the phone and say, yes, they're employed, yes, they're making this income. They rely on these third-party systems such as the work number. And those systems are not updated all the time. They might be only updated once a week or once every other week. It makes it problematic when you're on a Tuesday trying to verify for a Friday settlement and the work number hasn't uploaded or updated the borrower's income and employment situation. So in those cases, we're encouraging the home purchasers to talk with their immediate supervisor about the problems that we're encountering and encourage them to allow our processing team to call the supervisor so that we can verify directly with them if necessary in case these automated systems aren't functioning properly.
All right, so we've heard this adage before, communicate early and often. Yeah. And I think that came from the military or something, but I think it applies here because for anybody watching, if you're employed by a smaller company or you know you've got an automated system, what you probably want to do, like Don says, talk to your supervisor and say, I'm going to need somebody to respond quickly. Are we going to have a problem? Do I need to, we reach outside the box and get a live person to make a proactive call. Something like that would be really helpful, right?
Absolutely. Yeah, that would be very helpful. And it's taken a few days, few weeks to incorporate these changes into our the baseline of what we do on a day-to-day basis and how we communicate. But as we move forward, we realize what has the biggest impact on the pre-settlement conditions, as you mentioned. And this is certainly one of them. So we're asking up front for that information.
So if somebody hears that their HR manager's going on vacation, ask some pertinent questions, call your loan officer and talk this through, sort of the what if plan B scenario, so you don't get stuck.
Or as I experienced today, the HR manager was on maternity leave. So we made, thankfully we asked early enough, so we made alternative arrangements to get that verification from them. So
yeah, see, these are the things that we all have to be thinking of that we didn't have to before.
Right, exactly.
So Don, this brings up a good point. These are folks who are employed. What about the self-employed? It's always been a little more complicated for them. How does this scenario look different for them now?
Yeah, well, I'll review what we had to do in the past for self-employed borrowers. It was much easier to do. We would review 2 years tax returns, both business and personal, and we would get a year-to-date profit and loss and balance sheet. We might do additional verifications, such as making sure that the license is up to date to make sure that they're still in business. But that was really about it for self-employed borrowers. Now, within 10 days of settlement, we have to get bank statements that show they have received income commensurate with the income that we've used to approve the loan within 14 days of our receipt of that bank statement. So it's very difficult for us to do that. And you can imagine in this day and age, many self-employed borrowers they're hurting right now. It's a very difficult time for them, especially small businesses that just don't have the revenue streams. And if they don't have the revenue streams, unfortunately, that means that we've got to delay settlement until those revenue streams pop back up, until they're verifiable again. We don't know how long that's going to last, but I would imagine for self-employed borrowers, it's going to be a difficult process, unfortunately, for the foreseeable future, until we're back to full employment, until we see the economy recovering, and we can assume that these small businesses are operating as normal.
Okay, well, good to know. Yeah, just there's more to think about, more to do, but again, I say to my clients, isn't a month or two of, painful experience worth capturing these interest rates?
Absolutely.
You have more affordability if your rate is lower, even if house prices are rising.
Yep. I agree 100%. It's such a great time to buy right now that you can't ignore where the interest rates are. Just be patient, you'll get there.
Yeah, might take a little while, but
yep.
Don, once somebody enters the process, now I'm thinking about this from the purchase standpoint, not as much a refi, but they found a home, they've successfully navigated the home inspection, and now they move on to appraisal. Now, in some of my own transactions, we've had issues with appraisers not wanting to go into properties. And I was wondering, are you still seeing this? What other appraisal related kinds of issues are you seeing?
Absolutely. We are seeing appraisers hesitant to enter properties, and we're seeing sellers hesitant to allow the appraisers into the property. And that's an obvious concern when you don't know where somebody has been, who they've been hanging out with, and whether or not they've been quarantining themselves properly or wearing the proper gear as they're out and about visiting other properties. So yes, we see that as an ongoing issue. And there have been accommodations made. Thankfully, the GSEs, Fannie Mae and Freddie Mac, as well as other entities, have recognized that this is a major problem. In fact, when this first started, and early mid-March, early April, we had a significant delay in many appraisers going out to properties. They did not want to do it. And no accommodations had been made at that point. So the GSEs and other entities have said, okay, we're going to make it easier for a couple of things. Number one, to get an appraisal waiver. And number two, to allow for drive-by appraisals as opposed to walk-through appraisals to do the appraisal inspection. The appraisal waivers, obviously, those are fantastic in many cases. They're loan dependent, they're loan type dependent. We have to have that appraisal waiver authorized through the automated underwriting findings. So when we run a file through Fannie Mae's desktop underwriter or Freddie Mac's loan prospector, it will come back with a feedback finding for the appraisal itself and tell us whether or not we can waive the appraisal. At that point, we go back to the agent and in particular the buyer and ask them if they've gotten an appraisal waiver, whether they want to take use of that appraisal waiver, because in some cases that's not in the best interest of the buyer. If they anticipate the appraisal might come in low, they may want to take the appraisal. If they want also all of the data that might be included in the appraisal for their records, they may still want to get the appraisal, and that's fine. But that then brings us to the drive-by appraisal. So under most circumstances, the buyers and the appraisers can do a drive-by appraisal as opposed to actually entering the property. There are still certain product types that require a walkthrough, such as a cash out refinance and those kinds of things. But for most purchases, we have seen the tolerance for a drive-by appraisal. You know, the appraiser obviously needs to make sure the property is still standing, and you know, but they can't. What's that?
Basic details.
Basic details, yeah. But you know, it's, and I'm sure this will not be business as usual. I'm sure this will change back because there are many things the appraisers do when they enter the property, more so than just taking pictures of the property to make sure everything's functioning. But they do check, you know, plumbing to a certain degree, electricity, just to make sure things are secure and safe within the property. And those things will not go away. We want this protection for not only the lenders, but also for the buyers themselves. You know, I would say the appraisal is not necessarily done for the buyer. It's to make sure for the lender that the collateral is valued properly, but it does offer many protections for the buyer. And we don't want to discard that into the future unless if we don't have to.
Well, yeah, that makes sense. And I've had it certainly go both ways, where I've had a buyer who wanted it to come in low, and I've had a buyer who worried if it came in low, the deal would fall apart. So I certainly understand that. And I think in this day and age, one of the benefits of COVID, if I could word it that way, is there's been a lot of innovation, and a lot more realtors are putting good quality virtual tours online. So now appraisers can actually get, you know, if they've got photos and they've got floor plans and they've got, you know, Matterport, some people call it the dollhouse, or they've got a good virtual tour, they really can do a lot, you know, now, I think more than they could before, reliably.
Absolutely. And, you know, Fannie Mae and Freddie Mac, the industry itself has so many records of these properties. That is where essentially we can get the appraisal waivers, is through the data that's been collected over many, many years on these properties. So it's a lot simpler for them to, and I won't say anything with an appraisal is simple, but it is a lot simpler for Fannie Mae and Freddie Mac to dive into the details of the property to make sure the collateral is valued properly based on the neighborhood comps and the regional comps that they can access.
So, Don, I'm also wondering, you know, I'd asked about the appraisal process. What are you seeing in the jumbo market? Because I feel like it's cooling a little. Are you seeing things change in the jumbo market?
I am.
Find the jumbo market for our people watching.
Yeah, jumbo market, two different definitions. The true jumbo is anything over the conforming limit. And in this region, it's 510,400. Now there's a temporary limit of 765,600. That's the temporary high cost limit in this region of 765,600, or something around there. Yeah. But anything over that is considered a true jumbo. So Fannie Mae, Freddie Mac, the GSEs will not fund loans that are over that limit. Now, what we've seen in the past is that the jumbo market, the money that would normally be reserved for that loan limit is actually coming down. We were seeing those even in the jumbo conforming market. So anything over 510, 400, we were seeing non-conforming money available for those loans. But yeah, right now, the risk that is perceived on the back end by people that purchase the mortgage-backed securities is such that they don't want to purchase MBSs that are not guaranteed or in some other way backed by federal government or a GSE. So in other words, FHA, VA, rural housing, or any conforming loan. Those are backed to a certain degree by federal government and more so with Fannie Mae just by the GSEs themselves. Those are deemed to be less risky. When you get away from those products, i.e. jumbo or non-conforming loans, because they're deemed more risky or higher risk, the pricing is, they will adjust the price to bear that risk. So in other words, if a rate might have been low threes at one point for a jumbo, it might be low fours or low fives now for a jumbo product. Now that is bank specific. There are certain banks that hold on to their loans that won't necessarily package them and sell them on the back end. So they have more of a capability to do a non-conforming loan at a price and a rate that is within the range of where we should think it should be. Now, that's not going to continue either. That will, at some point, mitigate itself. The risk will be, the perceived risk will be diminished, and we'll be able to get back into the jumbo market. But right now, your views on that are absolutely correct. We're seeing less opportunity for jumbo money. It's still out there, but that pool has shrunken from what we can see.
Yeah, it's funny how we feel it in our practice and then go back and say, hey, is this happening? Because here's what I'm seeing,
Right, exactly.
Don, we're getting close to the end of our time. So I wanted to ask you, what advice would you give somebody entering the market today?
I would just say, stay confident, stay focused on the goal. The rates are so low right now. If you still have confidence in yourself, if you're still gainfully employed, then there's no better time to take advantage of purchasing a house. Granted, it's a competitive market out there, but you have to look at what the future holds for that financial instrument, the home that you buy, and the ability to buy at such a low rate. For those that are not ready to buy right now, again, it's, keep saving your money, keep paying attention to your credit to make sure that your credit is in good shape once you're ready to buy, and the opportunity will still present itself to you.
So I think, that my takeaway here is, yes, it's harder, but it's worth it because the rates are so good right now.
Absolutely.
And in the forecasts I hear, foreseeable future, we think, who knows into next year, but in the shorter term, next 3, 4, 5 months up to the election should be pretty decent, right?
Yeah, in terms of rates, we don't see any major shift higher for sure.
Okay.
So yeah, the market just is not pricing that risk into the future. They look at rates being low for the short term.
Good. Well, I think I wanted to see if we had time for questions, but we had such a good conversation that we have used most of our time, and we try to keep it pretty close to half an hour. So here's what I would say. If you have questions, whether you're watching this now or later, you can always shoot them off to me or Don. Don, would you give your contact info? And Jennifer may have a graphic she can put up for us.
I would love to give my contact info. It's Don Frutchey. My phone number, there we go. Look at that, with a picture and everything. You can see my cell phone, 703-303-5432. My email address, don.frutchey@firstcountymortgage.com.
And you can see Don's hair pre-COVID.
Yes, you can. Yes, you can. I'm liking it though. I might keep it as it is.
I like it. I like it too. It did you fine. Not so with everybody. I've got a lot of
Less,
great.
less formal.
Yes. So thank you, Don. Thank you for joining us today. I encourage anybody who's got questions, whether you're purchasing, first time, seasoned, refinance, whatever, please reach out to Don. You know, in a practical sense, if you want to ask me, what do these steps look like as you go through the process? I'm happy to answer any of your real estate questions. So we can always put you in touch with Don later. Don, thank you. I've really enjoyed having you with us today. I always enjoy having you as a referral partner. Thank you for helping all my clients over the years. And we're going to be here again in 2 weeks. So we have decided, with it being summer and things opening back up and people getting busy again, we're going to do this every other week. So in 2 weeks, and that will be Tuesday, June 16th at 1 p.m., we're going to welcome Rick Reich of Digital Recollections. And that sounds like a mouthful, but what Rick does is really cool. If you've been stuck at home and you've been finding old photo files or slides or negatives, and you want to put something together for your family, or weed through them and keep only the stuff that's important, he can digitize those for you. And we're going to talk a little bit about the kind of service he provides and how you can get some of that stuff off your to-do list. So that's 2 weeks from today at 1 o'clock. And then if you want to see this in the future or share it with somebody, which we hope you will do, it will be on our Facebook pages and it will be on YouTube, and we're always happy to shoot you a link. Thank you for joining us for Ask the Expert. If you need an expert in real estate, or you know somebody who does, I hope you'll keep my information and pass it along. I'm always happy to help your buyers and sellers. So thank you again for joining us. Jennifer, thanks for the information on the back end and for organizing things for us. And we will see you next time.
Thank you, Ann. Enjoyed it.
Thank you. Bye.
Bye-bye.